Hello, this is Steve Sanangelo from the SRS Rock Report once again. And today I'd like to do an update on the coming big oil price drop. And will that cause the next stock market crash? Will it be a factor? It's a good question. And if we look at a trend in the past, it just might be. So let's get going. This first chart here is the Dow Jones Index, which is shown in the gray area. And the West Texas or the U.S. oil price is in black. Now, the oil price fell from a peak of $105 in 2014. In the beginning of 2014, it fell all the way to $30 in 2 years. Now, when it bottomed, we see the price recovering, and as the oil price recovered, so did the Dow Jones. Now, part of the reason for the increase in the Dow Jones index was the election of Donald Trump as a president. But we can clearly see as the oil price increased, so did the Dow Jones. Now, when the oil price doubled in the last 2 years, something interesting happened on the net commercial short positions. Now, this is the COT report, and what they do, they keep track of the commercials, which are the big banks. And right here is the net commercial short positions. They're shown in red. And the blue ones are the large speculators. In just 1 week, the net commercial short positions in oil increased from 648,000 to 674,000. They arrive at this figure by going to the commercial list here, and we see 1,440,710 short contracts. They subtract their long contracts, which are 766, 612. So that's how they arrive at this number, 674,000. Now, as we look at this chart, and it's for 1 year, it is the highest amount, but that's only part of the story. Let's take a look at it over a 20-year period. Now, I've published this chart in an article of mine, but this is an update. It's by the Sentiment Trader, and as we can see, we have the oil price in the black line, peaked $147. In 2008, fell down to about 25. And then over the next 3 years, actually over the next, from 2009 to 2005 years, it recovered. What's interesting here, even though we see a higher peak, $110, as the oil price recovered and moved to 105 here, look what happened with the commercial short positions. When the oil price bottomed in about 2009, they had a net zero short contracts. So they were even. Their short and long contracts were even. But as the oil price continued to increase over those 5 years, we can see their net short positions, even though they're fluctuating, they hit a new record of 500,000 right here, right when the oil price was peaking. So as the oil price fell to a low of 30, until 2016, the commercials liquidated their positions, and at the lowest number, they got to about 180,000. Now, as the oil price has doubled from 30 to 64, where it's at right now, look what's happened to the commercial short positions. They are at a record 674,000, and it is the lowest going back 20 years. So looking at this setup, if we go by trends in the past, we're going to see a big correction. Now, it might not be this first correction. We could see $5, $8 correction and then a movement higher. The commercials could go up, but they can continue to increase theirs. I would say maybe in the first or second, we could see a huge correction in the oil price. Now, this chart shows how quickly the commercials have added their short positions on the U.S. West Texas oil price. In the third week of June, the price of oil was $42. It fluctuated up, but now it's trading at $64. In that 6-7 month period, the commercials have almost doubled their short positions. They've added another 324,000. And according to technical analysis, this little shooting star here is normally denotes a top, but we don't know. It could actually continue higher. We just have to see. Now, I brought you back to this chart because I wanted to show you that in 2016, as the oil price doubled, the Dow Jones index increased 56% in that 2-year period. Now, if we go back to 1987, and this is where I saw a similar trend. Again, the oil price was $30 in December 1985. It fell all the way down to $10. This only took 7 months compared to 2 years for the present oil price correction. But look how much it fell. It fell about it fell almost the same percentage terms as the 105 down to 30. Now, as the oil price continued to correct and move higher, so did the Dow Jones index. If we go by the price of the index when the market started to correct, it was about 1,700 points, and it moved to 2,700. I looked at that calculation. That calculation at this period of time was about a 60% increase. Now, if we go back, we're about a 56, 57% increase in the same kind of period. Now, this is the same period, but about 4 or 5 months later. So as the oil price recovered in the 1980s, in 1987, we had a peak of the Dow Jones at 2,700 points. We had a bit of a correction, and then we had the infamous Black Market Monday, October 19th correction where the market lost 25% in one day. Now, as I mentioned, the oil price, as it was moving higher, we see a correction here, a pretty substantial correction, and it happened prior to the market topping. Could that happen again this time? It's a good, I think it will. But now when the markets finally did crash, it impacted the price of oil. It really fell, not to its lows, but down to $15. So this time around, the price of oil is, let's say it's 64, 65. If it gets down below in the 40s, it is very bad news for the U.S. shale oil industry. They cannot survive at $40, $50 oil. Okay, I want to get back to the Dow Jones. This is over a 36-year period of time, because it just goes to show you how quickly we're seeing this increase in the stock market, how much of a bubble it is. When I first started writing about it, November 3rd, the Dow Jones index was 23,539. 2 months later, 25,295. And then presently, it's at 25,803. Now, I've added back the volatility index, and the volatility index in red. All that means is when it's low, that the market believes there's no fear, there's no worry in the market. The markets are very complacent. When we see it spikes up here, there's a lot of fear. And it corresponds to the low when the market is crashing. So as the VIX index falls, the stock market goes to a peak, and then as it corrects and the VIX index increases, that means a lot more fear, then the markets are selling off. Now, a few weeks ago, I showed a low of 9 for the volatility index. It's now at 10, but it's the lowest in history. And as we could see, the market is really moving straight up. Now, I wanted to share this article that was written just a few months ago. And Kyle Bass, who was famous for betting against the mortgage-backed, the subprime market, made $1 billion doing that. He's made some interesting calls, but I agree with him on this one. In the article, it says, today's market resembled the 1987 debacle on steroids. Now, I'm going to skip some of this, but what it says here, Bass discussed what he sees as the many short and long-term risks to the equity market, including the rise of algorithm trading and the passive investment, which have enabled investors to take risks without understanding what they're doing, leaving the market vulnerable to an air pocket. And with so many traders short volatility, now, if we go back here, this is the volatility index. I have read articles that there's massive amount of trades, bets. I've heard $1 trillion, $1.5 trillion in all the different volatility assets, ETFs that you could get your hands on. There is a massive amount of bets on the volatility, and also shorting the volatility that they're going to continue to see it fall. So what Kyle Bass is saying, And with so many traders short volatility, Bass says investors will know the correction has begun when we see a 4 or 5% drop in equities that snowballs into a 10 to 15% drop of a hat. And so, again, the important thing he says here, the shift from active to passive means the risk is in the hands of people who do not know how to take risk. Therefore, we're likely to have a 1987 air pocket. This is like portfolio insurance on steroids. Now, the issue back in 87 was this portfolio insurance, the leverage in the portfolio insurance, the way algorithm trading is now running the marketplace. Some of it has to do with this huge volatility. Now, the last chart here is on the NYSE margin debt, the New York Stock Exchange margin debt. And it's shown in the red line. Now, I have produced this chart before, but it's good to look over it again. As the New York margin debt increased, we could see in 99 it went to 400 billion. The S&P peaked. As it crashed, so did the S&P. Now, as we move back up in 2007, we see a $450 billion of margin debt. Well, the S&P also peaked and declined, and when it started to recover, now we're at nearly 600 billion, and we could be already there. This chart is about a month old. So as the traders now have margin debt close to 600 billion, it's 150 billion more than what it was in 2007-8, and it was 200 billion more than it was in 1999-2000. So we're just setting up. The leverage now is setting up for a massive market correction. And I believe we're going to see that this year. Chances are we might not, but I really think we are. And when we do get this correction, not only will it impact the oil price, and that's not good for the U.S. shale oil industry, and that's not good for the U.S. economy. I believe it will be very good for those in the precious metals who have been very patient for the last 10 years. Because when we see this market correction, we're going to see a lot of movement in gold ETFs, and we're going to see much higher gold and silver prices. So please continue to check out. I will be putting 1 to 2 of these videos a week. Also, please consider subscribing to the SRS Rock Report. And if you enjoyed this video, please forward it to other websites or friends and family. I just want to thank you again for joining us, and have a good day.